The most dangerous moment in any plan is when you believe you've eliminated all risk. In 1998, the smartest people in finance created the perfect system. Two Nobel Prize winners, the best mathematicians in the world, computer models that had solved the market. They believed they had done something no one else had, removed uncertainty from investing. 4 months later, they lost $4.6 billion and nearly took down the entire global financial system. This isn't a story about math, it's a story about what happens when intelligence meets hubris, and why the smartest people sometimes make the dumbest mistakes. The setup, the perfect system. Long-term capital management launched in 1994. The founders weren't typical Wall Street traders, they were academics. Myron Scholes and Robert Merton, who would win the Nobel Prize in economics. They built mathematical models so sophisticated that most people couldn't even understand them. The first 3 years, 40% returns, then 41%, then 43%. Everyone wanted in. They weren't just beating the market, they were dominating it. And here's what made them different. They didn't just believe in their models. They knew their models worked. They had math to prove it. Equations that predicted market behavior, risk calculations that showed exactly how safe they were. So they started using leverage, borrowing money to amplify returns. 10 to 1, then 25 to 1. Eventually, 30 to 1. They weren't worried because the model said it was safe. The math said the risk was minimal until 1998, when something happened that wasn't in the models. The psychological trap, overconfidence, the belief in perfect models. Russia defaulted on its debt. Suddenly, markets started behaving irrationally. Things that shouldn't correlate did. Safe bets became dangerous. Predictable patterns vanished. The models didn't account for this because historically it had never happened this way. Day 1, $500 million lost. Week 1, $2 billion lost. Month 1, $4 billion lost. The Nobel Prize winners gathered, rechecked the math. The equations were correct, but the markets didn't care. Here's what they missed. Their models were based on the past. They assumed the future would behave like history. It's like creating a perfect map of the world as it was last summer. Then winter comes. The landscape changes. Rivers freeze. Snow covers landmarks. Paths disappear. Your map is still perfect for a world that no longer exists. The overconfidence trap. This is the overconfidence trap. The more expert you become, the more convinced you are that you've seen everything. LTCM had 3 years of perfect performance, 3 years of data supporting their models. So they believed, we've accounted for everything. We've eliminated the risk. We're too smart to fail. But expertise in the past doesn't protect you from the unprecedented their models couldn't predict. Political collapse in Russia, panic spreading globally, correlations that had never existed before, not because the math was wrong, but because the math was based on a world that was predictable. And markets aren't predictable. They're human, and humans panic. The parable, the mapmaker's error. There's a parable about a mapmaker. He spent his entire life creating the most detailed map ever made. Every tree, every stone, every path. When he finished, it was a masterpiece, so detailed, so accurate, that he burned all the other maps in the kingdom. Why keep inferior maps when we have perfection? For years, it worked flawlessly. Travelers praised it. It's exactly accurate. Then winter came. The landscape changed. Rivers froze and could now be crossed. Snow-covered paths disappeared. Landmarks were buried. But the Mapmaker's map showed summer. Travelers got lost. Some died in the cold. "Your map is wrong," they shouted. The Mapmaker insisted. "The map is perfect. I measured everything." He was right. The map was perfect. For a world that no longer existed, he had mapped the past perfectly, but mistaken it for the future. The Mapmaker, the Nobel Prize winners, your expertise. You've been in your field for 10 years. You've seen every pattern, handled every situation, built perfect systems. Then something unprecedented happens. A technology shift, a market change, a global event. Your expertise doesn't prepare you, because your expertise is based on what was, not on what's coming. And the more expert you are, the more confident you become that you've seen everything, your investments or your investment strategy. It worked for 5 years straight, back-tested over 20 years of data. So you go all in, maximum leverage. The data proves it's safe. Then 2020 happens, or 2008, or something you've never seen before. The strategy was perfect for the markets. Your plans or your life plan, you've mapped it perfectly. Career trajectory, financial milestones, life timeline. Then life does something your plan didn't account for. The plan wasn't wrong. The world just stopped following it. Here's how to avoid the overconfidence trap. Step 1. Assume you're wrong. Before every major decision, ask, what would have to happen for this to fail? Not, can this fail? Everything can. But how specifically would it fail? If you can't imagine failure scenarios, you're overconfident. Step 2. Build in margin for error. The experts at LTCM use 30-to-1 leverage. That means they needed to be right 97% of the time. No one is right 97% of the time. When you're confident, build in extra safety, not less. Step 3. Update your map. Your expertise is based on the past. The world is changing. Ask regularly, what do I believe that might no longer be true? Long-term capital management collapsed in September 1998. The Federal Reserve had to organize a bailout. $3.6 billion from Wall Street banks to prevent global financial catastrophe. The smartest people in finance, with perfect mathematical models, lost everything. Not because they weren't intelligent, but because they confused intelligence with certainty. In a complex world, the smartest thing you can say is, I might be wrong. Confidence is useful. Overconfidence is lethal. The map is not the territory. The model is not the market. The plan is not the future. Stay humble. Stay flexible. Survive.